Okay, great.
We have to click on that, right?
Okay. All right, well, I'm going to ask everyone to mute their lines here, and I'll kick off. And I think what I'd like to do is just probably take next half hour and have Nancy go through a couple of her slides and her thoughts for where we are from an economic standpoint. So I'll turn over to Alex to introduce Nancy in a moment. I would just set the stage by talking a little through why we have these calls and how often we do them. We're trying to do something like every quarter to have someone come on and talk a little bit about the economic landscape, whether it's the overall markets, equities, fixed income, whatever it might be. And I think the open architecture of having like Snowden Lane not having a proprietary research firm and being able to go out and utilize different opinions benefits our clients, and it's good to be able to hear from different sides and take Alex. What she does is she'll take that couple of different views and kind of mold that into what our overall portfolio view is. So thank you, Alex, for being able to set up the call today, and certainly thank you, Nancy, for taking the time. I would just also mention that our next call will be more of like a planning call. And we want to talk a little bit about aging parents from a standpoint of, we've had a lot of conversations with clients in the last couple of months about them having to take care of their parents. So from both standpoints of the kids and parents' point of view, to talk through how does that planning go? What kind of care will they need? Is there any estate planning involved? Is there any trust setup involved? And then we actually are also having a therapist join to talk a little bit about how to approach those topics and some of the checklists that you might want to make in terms of setting the family up for successfully helping parents transition. So that will be our next call. We're excited about that, but certainly not as excited as we are about being lucky enough to have Nancy continue. And she's come on the last probably 4 years or so, maybe more. And so once a year, she's able to come on and give us her views. So with that, I'll turn over to Alex, and she can give a quick background, and then we'll turn over to Nancy. Thank you.
Thanks, Jesse. Hi, everyone. This is Alex. Thank you so much for your time today. As Jesse mentioned, this is going to be the first call in a short series we're having to round out the year. And we decided to kick it off on a strong foot with Nancy Lazar today. Nancy is the Chief Global Economist at Piper Sandler. Prior to joining Piper Sandler, Nancy co-founded Cornerstone Macro. Nancy is a legend in the industry, and we are really excited to have her here today, as you are. On this call, Nancy's going to delve into the economic landscape, as Jesse had mentioned, and she's very graciously agreed to participate in a short Q&A session after her talk. So we encourage everyone to engage and gain insight directly from one of the greatest minds in our business. So with that, I'll turn it over to Nancy.
Great. Thank you, Alex. Thank you, Jess. I'm going to share my screen. And I think it's a lot easier to visualize rather than just to speak. And I'm starting actually in the middle of my handout because I think I want to make a very, very simple point, which is just because we haven't had a recession doesn't mean we won't. Indeed, we are forecasting a recession. We think real GDP will decline about 1% over the next year. We think the unemployment rate will increase to 6% over the next year. And the question is why? It hasn't happened yet. The Fed's been tightening now for over a year. Well, there are long and variable lags. That was made famous by a gentleman called Milton Friedman decades ago, but that still holds today. It's not different this time. Specifically, if you look at a very simple table, all I've done is when was the trough or just before the first Fed tightening, and when did you start to see the unemployment rate go up? And the answer is, on average, almost 2 years. If you look at the table, 18 months to 2 years, there is one major outlier, and that is to the 2004-2007 period. What was that period? That was a period of massive credit growth, and the banking system was providing a lot of credit to the housing industry which we now know was a mistake. So basically, even though the Fed was raising rates, the banks were throwing a lot of money in the economy, but that's the exception, 36 months. The norm is closer to 18 months to 2 years. So the Fed started to raise rates in March of 2022. Now that we're moving into the fourth quarter of 2023, we're just now moving into the zone of where that Fed tightening cycle should start to lift the unemployment rate. Now, it did go up, actually. It's gone from 3.4 to 3.8%, but that is still very, very low. But again, we have sophisticated models that tell us we're most likely to move to 6, but this is just visually the easiest way to highlight that it takes time for a Fed tightening cycle to work its way. So why are we forecasting a recession? One, the lagged effects of this significant tightening move. Are there any other signs that the employment backdrop is starting to deteriorate? Well, there's a survey done by the Conference Board, and it's a survey of consumers. I've used this series for decades, and the consumers are getting worried about the unemployment rate. I used this series back in 2020 to get really bullish on the economy because the consumer never felt as bad about the unemployment situation as the official data did. You soared above the 2010 peak if you used official data, but the consumer went, nah, it's not that bad. I was given a lot of money. I still have my job. And so they became bullish on the labor markets very, very quickly and never got as egregious. But now they're starting to see things deteriorate. Also on the job side, you're starting to see companies pull back on temporary employment. If any of you have run a business before, if you think about it, that's the easiest lot to get rid of first, right? They're not permanent people. You usually are working with an agency, and it's a relatively easy part. Prior to recessions, temp employment always clearly declined significantly, which is what we are seeing, today. On average, it takes about 12 months of the Fed tightening cycle to see payroll employment gains slow, which is what has happened. Payroll employment gains are slowing. Why does it take 12 months? Because again, of the lags in Fed policy on the economy. In particular, it's called a business cycle for a reason. It is businesses that create jobs. And if businesses are doing well, then the job market's going to be doing strong. And if businesses are starting to struggle, then you start to see employment gains weaken. Well, you're seeing tremendous amount of downward pressure on corporate revenue. Corporate revenue growth has slowed dramatically, up only about 2.5%. The orange line here, only up about 2.5% year over year. Again, why is this important? Because companies hire people, pay wages. And if they're now starting to see revenues struggle, then they're going to start to cut costs. And indeed over here, domestic corporate revenues, let's look at this is a year-on-year change. Look at the level. It's still elevated, but it has kind of stalled out at a high level. And many companies, when you go to the store, you see this, have raised prices egregiously from a can of soup to a car. And so they've used those price increases to support their nominal activity. Real revenues are actually down about 1% on a year-over-year basis. You've always had a recession when real revenues start to decline, and you can see a level chart over here. If you're running a business and your real revenues are declining, you're going to start to cut jobs. And that's what I'm showing you on this chart. Corporate revenues have declined in real terms, correlates very well historically with the growth in employment. If you go back and hone in, let's go back and look at 2007. What you see is corporate revenues are deteriorating, declining real revenues. They started to decline in the first quarter of 2007, and payroll employment started to decline in the first quarter of 2008, roughly a year later. So again, there's 1 year lead. Now you're starting to see real revenues again decline. They actually started to decline in the fourth quarter of 2022, opening the door to employment declining in the fourth quarter of 2023. So the last thing you do when you forecast is forecast based on where the current data are. The key is to look at leading indicators, of which obviously Fed policy is one. Another really important leading indicator, I can blow this up a little better. I didn't realize. Another really important leading indicator is what are banks, how do banks feel today? As I mentioned, banks in 2000, pardon me, banks in 2004 through 2006 were actually easing lending standards pretty aggressively. Even though the Fed started to raise rates in 2004, they hadn't yet really tightened lending standards. It didn't happen until really the fourth quarter of 2007. The recession started in December of 2007. Today, banks are very aggressively tightening lending standards. In fact, you've always had a recession whenever this index has been this slow. Someplace in here, I have one going back to 1960, but in any event, you've always had a recession, never a soft landing when banks. So you have two leading indicators: one, increase in interest rates, and two, banks tightening lending standards. Why are they tightening lending standards? Because they see delinquencies. Consumers are going delinquent on auto loans and credit card loans. And we also know they see problems in the business side. And that's why they're tightening lending standards. And over here, I take now the blue line is banks tightening lending standards, i.e. making it more difficult to get a loan with retail sales. Retail sales have slowed. And at the end of the day, this measure suggests they're going to decline as you go into 2024, which we think they will. So just because retail sales are positive today, which they were in August, doesn't mean they're going to be positive 6 months from now. You have to look at what drives that. So if consumers are under pressure because the job market is starting to deteriorate, the unemployment rate is going up, banks are tightening lending standards, making it more difficult to have access to credit, you're going to see a decline in consumer spending. Let me jump to housing. There's been a lot of volatility in housing this year. But I think we all know mortgage rates are egregiously high. House prices are egregiously high. Affordability is very low, if not a record low. And as a result, at the end of the day, housing has been very depressed. And we actually think it declines even further as we go into 2014. Mortgage rates, again, most people have never seen mortgage rates as high as they are today. They're at risk of going even higher. Just today, Treasury bond yields are moving higher. So we think housing remains very weak. You can't afford to buy a new home, therefore you're not selling your new home. And so there has been some incremental strength in new house sales, but that's a small part of the economy. At the end of the day, existing house sales, overall house sales, and new and existing, are very, very depressed. And again, based on the lagged effects of the tightening cycle, we think housing actually is going to decline, is going to decline further. I would actually argue we have a house price bubble with house price to income egregiously high, higher than we were in 2006, making this an extreme excess, creating risks as we go into 2024 for problems. If people start to lose their job, are they going to be able to afford their homes? Again, housing affordability is breaking out to all-time record lows, given the combo of high rates. Now, we call this a business cycle, and we are very focused on capital spending. And then I'm going to wrap up and touch on inflation. But here is real capital spending. What does this include? It includes factories, office buildings, computers, research and development. It's roughly 13% of GDP. Capital spending we thought would be the strongest part of the economy this year. It has been growing about 4.5%, but there are similar headwinds here. They are also driven by banks' lending standards. Interest rates are up, so we think we stall out here in the fourth quarter, and we actually think we decline as we go into 2024. Again, because banks are tightening C&I loans. I have been very, very bullish on what we call the manufacturing renaissance for over a decade. To be sure, the combination of COVID, the supply chain disruptions we've had has continued to reinforce that theme. But it's been created a lot of inflation because it's been so robust. But this isn't a big enough part of the economy. It's only about 0.6%, less than 1% of the economy. And within building stuff, companies building stuff, there are a lot of other areas that are struggling, in particular office buildings. And so net, overall, the building of stuff by businesses is up a little bit, but not particularly elevated. And again, banks are tightening lending standards egregiously in this space because of the commercial real estate problems that we have. So net capital spending also slows. Last, what does this do for the inflation picture? Well, our bottom line is we need a recession in order to curb inflation. And why is that? Because we need a weaker labor market to curb labor costs for companies. There is a very strong link between what labor costs and core inflation. And that's what I'm showing on this page. That's something that's called unit labor cost. It's compensation relative to productivity. How productive is that worker? And we have had a surge in costs for companies for their compensation. Wage gains have gone up and productivity has been flat to down. It's not serendipity that this measure is 9% above its pre-COVID trend and core CPI is 9% over its pre-COVID trend. You can see historically they're linked. Companies' labor costs go up, company price of goods goes up. And historically, in order to get unit labor costs down, you need to see clear weakness in the unemployment. You need to see a very clear increase in the unemployment rate. So we're going to end on where we started, which is that we do see the unemployment rate moving up to 6%, which is what we would call a normal recession. That's where you've been historically. A more severe recession is when you get double digit, as you were in 1980, and then again in 2009. Excuse me. And so at the end of the day, it's a necessary condition to get a sustained shift down in inflation, to get a sustained shift up in the unemployment rate. We've had 3 soft landings. 2 of those 3 soft landings saw inflation reaccelerate very quickly because unit labor costs were elevated. Which you can see here. Unit labor costs are elevated. They were elevated in both 1967 and 1985. The Fed eased a little bit. Inflation came back. They had to tighten things very dramatically because inflation did reaccelerate. The only time you had a successful soft landing where inflation stayed low, the Fed didn't have to come back and tighten aggressively quickly, was 1995. And that's because unit labor costs were low, which is where we are not today. So let me stop there and see what questions y'all would have.
I'm going to kick us off just because I have a follow-up question on what you're talking about. I'm just wondering, and this could be a very silly question, but I'm wondering the increase in all this immigration that we're all seeing in the news and hearing about, would that have any material effect on potentially lowering labor costs without the unemployment needing to go up so much?
Well, it would incrementally increase labor supply, which is it's a great question, actually. And the question is, what income cohort would that potentially most affect? It's the lower income cohort. It's a very, very segmented area. It could help lower wage inflation. We were watching this like a hawk, incrementally. Again, most of these workers are unskilled workers, so it could incrementally help lower wage inflation. But this is the transportation and warehouse industry, 6% wage inflation. These are not year over year. These are relative to just 6 months ago. Manufacturing, I don't think, maybe they could drop in this bucket. I don't think they can really drop into the manufacturing bucket. Construction, probably they could participate in that. In fact, I was talking to a construction company yesterday, and he said he can't get any labor. He said the only labor he can get are from Mexico. And then you have Home Depot over here, where they're about 9. I'm not sure. You need to be obviously have English, but it could help.
Okay.
I don't think it's
So,
a danger, but it could help.
okay. So when we talk about recession, potential for recession here, and then this is a very hard thing to predict.
Mhm.
And just as the market pull back during some kind of recession is also very hard to predict in terms of severity and timing
Mhm.
and so forth. Do you have any feeling for either of those? Is there a way to gauge, um, if we're coming from a pretty healthy economy, but all of a sudden we've had a major increase in percentage rates and so forth? I mean, is there any way to, we talk a lot about creating an all-weather portfolio that, and having a portfolio that's going to expect these types of pullbacks. So I guess the question is there any way to predict that, or is there anything that we're talking, I'm sure some of the things that we're talking to clients about, was there anything that you would suggest to be talking to clients about for this type of pullback, and any color on either of those?
As far as the timing, again, our models all point to the fourth quarter of this year, and it may not be till December of 23. Could it be the first quarter? The working with our strategy team, if we more clearly move into a recession, then you become obviously more defensive. Utilities, healthcare. Is this where you're going? This is based on my strategy team recommendation. I think there is one unique situation today that classically the community would say to go into staples. We are uncomfortable with that. History does not always repeat. And the staples community, I don't care if you're Smucker's or Campbell's Soup, I can go on and on. You have egregiously raised prices. And we are starting, I don't think I have General Mills in here, but General Mills last week is really getting smoked because they've also egregiously raised prices. Now they don't have as much pricing power. Again, the Fed is trying to curb that pricing power. They've egregiously raised costs in many sectors, and their stocks obviously haven't responded very well because people are moving away from Campbell's Soup to private labels within grocery stores. So classically, move into once it becomes clear we're in a recession, and it's not clear at all we're in a recession. But then the defensives and the high quality, but also more defensive names. We're not quite there.
Hi, Nancy. My name is Fred. Thank you for the time today and the slides. My question is more about wage inflation and if there's any tie into the recent strikes we've seen across a number of industries, Teamsters with UPS, the writers, the actors, the auto workers now, potentially more on the horizon with, I think, pilots and stuff. So I struggle to understand how, on one hand, strong wage inflation, and then how is that translated to, well, I guess, you had mentioned consumer delinquencies going higher, consumer balance sheets maybe not as strong. And so I'm just struggling to make the connection, and any comments on some of the labor movements we've seen in the news headlines. Thank you so much.
Yeah, it's a great question too. I've been following these contracts all year. Our view has been inflation is sticky, in part because of these big wage increases, as we talked about. And there's an idiosyncrasy within unions, right? They're a 2 or 3 year, 4-year contract. And so what this chart on the left highlights is that union wage increases, the blue line, have actually lagged the non-union workers because they're set contracts over a certain period of time. Whereas in the sectors of the economy that don't have unions, people, in order to hire people, they were having to raise wages quickly, which indeed they did. And so what you're going to have this year is now you are seeing employment slow, and so wage gains are moderating some non-union wage gains, but then you're going to get a bump in these union wage gains, and so aggregate wage inflation is going to stay elevated. You even see the federal government and state and local government lifting wages I don't want to get political. I'll just say that if you are running a state, you want to give your workers a big wage increase. It's a nice way to obviously get support. And so at the state level, you're running about 5%. At the federal level, the administration just gave a 4.5% wage increase. Maybe it was 4.6 wage increase. So the federal government, quite frankly, and state and local governments are also further supporting bigger wage increases. So I think where you're going is, why in the world, if income is so darn high, are you seeing these delinquencies? And that's because, quite frankly, a lot of the support for the consumer over the past 3 years is starting to fade. A lot of consumers overspent, overborrowed, and at the same time, employment is slowing. And so you need to look at aggregate income, not just wage gains. And it's a function of what wages are doing and what employment is doing. And I'm going to kind of come to the conclusion first. This is a chart of consumer sentiment by household income. It's the orange line is that bottom tier, and they are basically in recession territory. That lower end consumer feels very, very squeezed. And why is that? They've borrowed too much. Employment gains are starting to slow. Even that middle income consumer is getting squeezed. The top consumer, this is as of September, so the data are pretty timely. Maybe they're topping out. So why is add to that list price levels. Again, when you go to the grocery store, if you need to buy new furniture, or if you need to buy a new car, I mean, this is the CPI, core CPI excluding food and energy. 9% above its pre-COVID trend line. If you look at food, 18%. You go to the grocery store. Energy prices were declining, now they're back up, and they're still 27% higher than their pre-COVID kind of stagnant level. And so add that bucket together, which is nominal income gains are slowing because employment is slowing. Price levels are remaining very elevated. Consumers, as we'll see here in a minute, borrowed a lot of money on their credit cards. And so you're starting to see with egregiously high interest rates. I've never seen anything like it. And Washington is actually looking at legislation to cap these credit card interest rates. I mean, all that's going to happen is fewer and fewer people will have access to credit if that's what they do. But you can see the borrowing that they've done. So it's really, and it's that lower end consumer in particular. In fact, there was a story today in our financial press that all of this incremental excess savings consumers have from a lot of the stimulus that was put in place. It's basically all in the hands of people who don't need it, the upper income, and that lower end consumer is really, really getting squeezed. And at the same time, you're now getting a surge in these student loan repayment proxies. So it is a difficult situation for many consumers around the country.
Thank you very much. That was very insightful. The way I'm interpreting it is the wage gains have not been enough for the bottom half or that lower tier. So it's interesting if you had any chart or anything on kind of shareholder returns or corporate profit growth. Wonder how well that has done.
Well, that's exactly what the UAW is talking about, in that we did have a very robust corporate profit cycle. And companies actually spent a lot of that revenue hiring people and paying wages. I've got something in here called the compensation ratio, which looks at total comp relative to corporate revenue. Sorry. There it is. Here we go. So, but to your point, I'm making a slightly different point here, but to your point, compensation relative to revenue is historically still very low, i.e. they could have paid more. Now, I have a problem with that. We need companies to be profitable to hire people, but this is quite a compelling chart for your point.
Thanks
This is
again.
what companies paid out to people, wages and employment relative to their revenue, and it's historically very low.
Thanks, Nancy. I had one question, if anyone would feel free to jump in to bring it back to a more positive topic. Investors have long relied on the 60/40 portfolio allocation, as we do with many of our clients. Today's dynamic landscape and the changing and evolving financial landscape, a lot of people are really scrutinizing the 60/40. And a few weeks ago, you and your team came out with a really excellent piece on the resiliency of the 60/40. Could you talk a little bit about the merits and potential drawbacks of the 60/40 approach, and what you see going, over the long run?
Yeah, long term, we have a very bullish outlook for the United States, and it's particularly relative to the rest of the world, but particularly here in the United States, because of the manufacturing renaissance theme. There's an underappreciation for how important it is to build stuff. And by building stuff domestically, by having more and more factories, you actually create a lot of goods producing jobs. And then you actually create a healthier environment where more and more people can actually get a job. And this process started actually the last cycle. And if it's easier to get a job, that means more and more industries are hiring. And that's what this diffusion index looks, percentages of different industries, from factories to restaurants, everything in between, Wall Street. And the more and more industries that are hiring, the easier it is to raise wages and improve productivity because you're investing in your business. And the easier it is to raise the labor force participation, which then goes back and caps wage inflation, i.e. maintains a healthy growth environment, and where you can actually raise real median family income. That started the last cycle. And it has all to do with the manufacturing coming back to the United States, creating a broad footprint of jobs. If any of you live in industrial towns, I grew up in Flint, Michigan, you'll understand the multiplier associated with the necessity to actually make stuff. And we're on that path. This is a cyclical slowdown, or cyclical recession, but longer term, here you can see more clearly, when we get a shift up in goods producing jobs, you get a shift down in the poverty rate, because there's a job multiplier. If you build a factory, you need a restaurant, you need a distributor, you need a trucker, and then you need a grocery store, and then you need a drugstore, which is what my dad did. And that's how you create a healthier backdrop, and why but it's important to crush inflation. There's nothing worse for an economy or a market, either stocks or bonds. I didn't write the 60/40 report, another colleague did, but as far as continuing to invest, in the stock market, that is definitely a very big part. On bonds near term, we would be a little cautious on the corporate side. We're not sure enough risks has been put into corporates, for a whole host of reasons, cyclically. But longer term, we're certainly very bullish on the outlook for the U.S. economy and markets.
Thanks, Nancy.
Nancy, I had one that one of our clients wanted me to ask you, that they couldn't attend today, but there's been some news with House Republicans demanding larger budget cuts moving into next year, which could possibly lead to a government shutdown. I was curious what you think if a possible government shutdown could mean for a fragile economy, or if you think that this might just be sort of more headline noise, or what's your take on that?
So we think, my colleagues in DC think there will be a short government shutdown. We've had them before. I think we had 2 the last cycle alone. They classically are not negative tipping points for the economy, but I think it's another real good question, given the fragilities that are kind of culminating as we go into the fourth quarter. It's certainly not going to be the straw that breaks the camel's back, but it certainly could pull forward incrementally some weakness. But we think at the end of the day, there'll be a relatively short shutdown. They'll come back with a short-term plan to fund the government, and then and to keep it open. And then by the end of the year, they'll come up with a permanent budget for 2020 for 2024. That's our view in DC. I'm more nervous about it. Washington seems a little. I like ending on a positive note. Now you've got me coming back to another negative note. There is some truth to the conclusion that federal outlays are egregiously high as a share of economic activity, with a 3.8% unemployment rate. For government spending to be over 20% of GDP, you can see historically very unusual, close to 25% of GDP. To have a budget deficit of 8% with a 3.8% unemployment rate, and with the deficits always deteriorating by a good couple of points going into a recession, this limits any fiscal support for an economy if we do have this recession we think we're going to have. So this is my biggest risk to the economic environment. They do government spending, and it makes it even a bigger deficit and a bigger share of GDP. How's the bond market can react to that? So this to me is a big risk, my biggest single risk. I'm normally a glasses half full person, by the way, but I have to call it like it is.
Thanks, Nancy. I think we're getting close to time, so I just wanted to see if anyone else had any questions before we come to a close here. All right, well, if anyone has any questions, feel free to direct them to me. Nancy, thank you so much for your time today and the very enlightening presentation. Eric, thank you so much as well for all your support. Everyone have a great rest of your day, and we'll circulate the call notes and the recording after.
Thank you very much. Bye.
Thank you, Nancy. Bye, everyone.